The dominance of the United States dollar in the global financial system is the result of a long historical evolution shaped by trade practices, institutional developments, geopolitical shifts, economic crises, and strategic policy decisions. It cannot be understood simply as a product of military power or political pressure, although those factors have influenced its trajectory. Rather, the dollar's position emerged from a combination of economic necessity, credibility, structural advantages, and network effects that reinforced themselves over time. To fully grasp why the dollar became the world's primary reserve currency, why U.S. sanctions can have such dramatic consequences, and why alternatives have struggled to replace it, it is important to trace the development of money, international trade systems, and post-war financial architecture in a clear and chronological manner. In ancient times, economic exchange operated primarily through barter. Individuals and communities exchanged goods directly, grain for livestock, textiles for tools, and so on. While workable in small localized economies, barter created significant inefficiencies as trade expanded. The double coincidence of wants problem meant that both parties in a transaction needed to desire what the other offered at the same time. Additionally, many goods were perishable or difficult to transport over long distances. As societies grew more complex and trade networks expanded, the limitations of barter became increasingly evident. To solve these challenges, civilizations began using commodities with intrinsic value and durability as mediums of exchange. Precious metals such as gold and silver became widely accepted because they were scarce, divisible, durable, and easily recognizable. Over time, standardized coins emerged, facilitating smoother commerce and enabling more complex economic systems. However, carrying large quantities of metal posed practical challenges. Gold and silver were heavy, vulnerable to theft, and cumbersome for long-distance trade. Merchants began depositing their precious metals with trusted custodians and carrying paper receipts that represented claims on those deposits. These receipts gradually evolved into early forms of paper money. In China, organized paper currency systems appeared centuries before Europe adopted them, and travelers such as Marco Polo introduced knowledge of these systems to Western audiences. Eventually, European economies institutionalized banking and formalized currency issuance backed by gold reserves. Under what became known as the gold standard, governments pledged to convert paper currency into a fixed quantity of gold upon demand. This system created stability and predictability in international trade because exchange rates were anchored to gold parity. Countries could issue currency only in proportion to their gold reserves, which limited inflation and encouraged fiscal discipline. During the 19th century, the United Kingdom emerged as the world's leading industrial and naval power. The British Empire's vast trade network, combined with London's status as a financial hub, elevated the pound sterling to the position of dominant international currency. A substantial share of global trade was invoiced and settled in sterling, and many countries held sterling reserves rather than gold because it was easier to store and transact. The British financial system was widely trusted, and the gold standard reinforced stability. However, the First World War profoundly altered global economic balances. Britain and other European powers accumulated enormous debts, depleted their gold reserves, and suffered industrial disruption. The United States, initially neutral, supplied goods and munitions to combatant nations and accumulated significant gold inflows. By the end of the war, the U.S. economy had expanded, and its financial influence had grown substantially. The interwar period brought instability, competitive devaluations, and economic turmoil, culminating in the Great Depression. Efforts to restore the gold standard proved fragile, and global trade contracted sharply. When the Second World War erupted, the United States again emerged as the primary supplier of industrial goods and military equipment. By the war's end, much of Europe and Japan lay in ruins, while the United States retained a strong industrial base and held the majority of the world's gold reserves. Recognizing the need for a stable international monetary framework to prevent a repeat of interwar instability, representatives from 44 countries met in 1944 at Bretton Woods, New Hampshire. The resulting agreement established a new system in which currencies were pegged to the US dollar, and the dollar itself was convertible into gold at $35 per ounce. This arrangement effectively placed the dollar at the center of the global financial system. The Bretton Woods framework also created institutions such as the International Monetary Fund and the World Bank to promote stability and reconstruction. Through initiatives like the Marshall Plan, the United States provided significant financial assistance to rebuild European economies. These funds were denominated in dollars, further embedding the currency into global trade and reserves. Countries held dollars not only for trade settlement, but also as official reserves, trusting that they could convert them into gold if necessary. This system functioned effectively for several decades, supporting post-war growth and expanding global commerce. Energy markets further reinforced the dollar's role. In the mid-20th century, agreements between the United States and major oil-producing nations contributed to the practice of pricing oil exclusively in dollars. Because oil became the lifeblood of modern industrial economies, countries needed dollars to secure energy supplies. Oil exporters, in turn, accumulated dollar revenues and often reinvested them in U.S. financial assets, particularly Treasury securities. This recycling of petrodollars strengthened U.S. capital markets and sustained global demand for the currency. The depth and liquidity of American financial markets made them attractive destinations for surplus capital. By the late 1960s, however, tensions emerged within the Bretton Woods system. The United States was running fiscal deficits and expanding its money supply, partly due to domestic spending programs and the Vietnam War. Foreign governments accumulated large dollar holdings and began questioning whether the U.S. possessed sufficient gold to maintain convertibility. As redemption pressures mounted, confidence in the fixed exchange rate system weakened. In August 1971, President Richard Nixon suspended the dollar's convertibility into gold, effectively ending the Bretton Woods arrangement. This decision, often referred to as the Nixon shock, transitioned the world toward a system of floating exchange rates and fiat currencies not backed by precious metals. Despite the removal of gold convertibility, the dollar retained its dominance. By that time, global trade, finance, and reserves were deeply entrenched in dollar-based systems. Network effects played a powerful role. Because so many actors used dollars, it was costly and complex to shift to another currency. U.S. financial markets remained the largest and most liquid in the world, offering a wide range of safe and tradable assets. The rule of law, relative political stability, and institutional transparency further enhanced confidence. The dollar thus evolved from a gold-backed anchor to a fiat currency supported by economic scale, financial depth, and global integration. This structural centrality gives the United States significant leverage in international finance. Many cross-border transactions are cleared through banks with exposure to the U.S. financial system. Even when two non-U.S. countries trade with each other, their transactions may be denominated in dollars and processed through correspondent banking networks that interact with U.S. institutions. As a result, U.S. regulatory authorities can influence or restrict access to dollar clearing. Financial sanctions exploit this interconnectedness. Primary sanctions prohibit U.S. persons and firms from engaging with designated entities, while secondary sanctions extend potential penalties to foreign firms that continue dealings with sanctioned parties. Because access to U.S. markets and dollar liquidity is often critical for global banks, compliance with U.S. sanctions tends to be widespread. When a country is cut off from dollar clearing or removed from key financial messaging systems, its ability to conduct international trade and finance can be severely constrained. Export revenues may become difficult to receive, imports harder to pay for, and foreign investment may decline sharply. Currency depreciation, inflation, and economic contraction can follow. The impact is magnified when sanctions target energy exports or major financial institutions. For these reasons, U.S. sanctions are often described as powerful tools of economic statecraft. They can influence behavior without direct military confrontation, though their effectiveness varies depending on the target country's resilience, alternative partnerships, and domestic economic structure. In recent years, debates over de-dollarization have intensified. Countries concerned about geopolitical risks or financial vulnerability have explored diversifying reserves and increasing local currency trade. Bilateral agreements to settle trade in national currencies have expanded modestly. China has promoted the internationalization of the renminbi, establishing swap lines and cross-border payment systems. Russia has reduced its exposure to U.S. assets in response to sanctions. Regional blocs have discussed shared financial mechanisms, and the BRICS grouping has considered proposals for greater monetary cooperation. Nevertheless, replacing the dollar as the primary global reserve currency presents formidable challenges. For a currency to assume a dominant role, it must meet several criteria. It must be freely convertible, supported by deep and liquid capital markets, underpinned by credible institutions and widely trusted as a store of value. Investors require confidence that they can move funds without capital controls, access transparent legal recourse, and rely on predictable monetary policy. At present, no alternative currency matches the combination of market depth, institutional stability, and global integration offered by the United States. The euro represents a significant reserve currency, but the eurozone lacks unified fiscal governance and a fully integrated capital market comparable to that of the United States. The Chinese renminbi, while increasingly used in trade settlements, remains subject to capital controls and does not yet offer the same openness or liquidity. The dollar's position is also reinforced by inertia. International contracts, commodity pricing conventions, and financial instruments are denominated in dollars. Changing these practices would involve renegotiating countless agreements and building new infrastructure. Even countries seeking to reduce dependence often do so gradually, holding diversified reserves rather than abandoning the dollar entirely. Over time, incremental shifts may reduce the dollar's share of global reserves, but abrupt displacement appears unlikely absent a major systemic shock. In summary, the global dominance of the US dollar emerged from historical developments spanning centuries: the evolution of money from barter to metallic standards, the rise and fall of imperial currencies, the transformative impact of two world wars, the institutional framework established at Bretton Woods, the strategic importance of energy markets, and the growth of deep and liquid American capital markets. The end of gold convertibility did not diminish the dollar's central role because network effects, economic scale, and institutional trust sustained its relevance. This centrality enables the United States to wield financial sanctions with significant global consequences, shaping geopolitical dynamics in ways that extend beyond traditional military power. While discussions of alternatives and diversification continue, the structural foundations of dollar dominance remain substantial. Understanding these economic and historical dynamics is essential for interpreting contemporary geopolitics, global trade relationships, and the complex interplay between finance and state power in the modern world.